It's basic language. Yeah, let's go to slide 2. Let's just skip on here. Why am I qualified to teach this class? I'm absolutely not. I am not a financial advisor. I'm not a financial planner. I am just a dumb real estate agent is why I'm here. So why am I teaching the class? Great question. I complained to Tom Allen enough that he told me to shut up and teach a class. So here we are. So the basis. Oh yeah. Oh well, yeah. I'm not much better. So really, why was I complaining? We do a lot of classes here at KW, at our office specifically. And, you know, the room gets packed full of things like retirement planning and like 1031 deferred exchanges. And like a lot of these really kind of graduate level, heavy, intensive classes. And you get a room full of new agents that don't actually know how to operate a business. And they're all fascinated with crypto mining or like whatever class they're going to come up with. Yeah. And fundamentally, they don't understand the basic principles of how money even operates. Right. So I thought it was kind of hypocritical of Keller Williams as a whole to teach people about things that is only going to injure them if they don't understand the basic language of what's behind it. Ergo, me complaining to Tom Allen that we don't teach these people the basics. And he said, all right, well, then shut up and do it. So here we are. It's a super small group. So I'm going to be like kind of super direct with all of you. Am I a human being or am I a business? Right. I'm actually going to turn a little bit. So Warren Buffett did this lecture at the University of Nebraska early in the 1990s. You can find it on YouTube, where he asked the graduating class, he said, if I was going to buy 10% of all earnings for the rest of your life, how much would you charge me? Looking to buy 10% stock in you right now for all earnings for the rest of your life, how much would you charge me? And fundamentally, like the first time I heard that, it was actually before I was in real estate. That was like a really fundamental question for me is what am I actually worth? Right? Because we're humans, right? And like we enjoy all these things and we look at our business as something completely separated from who we are as a person. But when you take a look at a person, really we operate by all the same principles that you should run your business by, right? Like you have a revenue, you have some sort of income, you have expenses, you have a net profit, right? And for some people that looks really bleak, right? Like you're trying to create enough income to pay your bills and expenses. You get to the end of it and there's no future planning. There's no large projects. There's no expansion. There's no, all the things that we take for granted in that make a business successful, such as cash reserves, such as like future plans for expansion. Like we don't do the same thing with ourselves. So not that I'm going to ask each of you individually, but if I was to say, Ray, how much would you pay for 10% of Trish? It's a hard question to actually answer is, okay, well, I have to find out a bunch of information about Trish in order to be able to tell you that. Otherwise, you can just throw a number out there. And I'd argue for most of you who are here, you're probably quasi financially savvy or at least curious enough that you're going to underbid what 10% of your future looks like. And then the next, I think, more general conceptual question is, looking at your own life right now, like to thine own self be true, would you even buy stock in your own company? Like, are you operating your life on the basis that you would buy your own company? Would you buy you? Would you buy Ray Brophy? Would you buy what time Ray Brophy wakes up? Would you buy what Ray Brophy eats? Would you buy what Ray Brophy, like at each level of what is Ray Brophy, is Ray Brophy making decisions worth investing in? And that's for a scope of my life, how a lot of decisions have been made is like, is this something profitable, right? For me, the business, which is Alex. You have a social security number, which is no different than EIN. You can treat it exactly the same way. Tax forms are pretty similar between the individual and the business. So why not think of ourselves as a business, which also operates outside of 9 to 5, operates 24 hours a day. Your next slide. So what is money? Right? Like fundamentally, let's talk about what is money at its most basic form, right? Like you have the classical Oxford dictionary definition of it's the actual monetary form of currency that we use to exchange goods. I I think a lot of people look at money as like this foreign object or this thing, right, that like exists, and it has its own power and its own life force. But it can be a tool or it can be a curse depending on who it is, right? And I'm gonna just jump to the next slide real quick. I'm actually gonna go backwards on this. Who's heard of the book Atlas Shrugged by Ayn Rand? Who's read it? Who's read it more than once? It's about 1,500 pages and it is painful. It is, I've read it 3 times. It's one of my favorite books of all time. But Ayn was a fictional female writer from the 1950s who was an immigrant from communist Russia, who was what I would classify as like a thoroughbred raw capitalist. But she wrote a series of fictional stories, including Fountainhead. Fountainhead's a good one too. But Ayn Rand in Atlas Shrugged, I think specifically probably did a better job of teaching people the principles behind money and behind capitalism better than a technical book or any college business class that I'd ever been a participant of. So the quote, which I'm going to read for people who can't see it. So you think money is the root of all evil, said Francisco d'Anconia. Have you ever asked, what is the root of money? Money is a tool of exchange, which cannot exist unless there are goods produced and men able to produce them. Money is the material shape of the principle that men who wish to deal with one another must deal by trade and give value for value. So as humans, what are we giving? Time, right? That's what we're trading. And it's really disturbing, especially when you're in real estate, if you break down your dollar per hour sometimes, and time spent, right? Because we exist in a lot of this, I'm going to gear more towards us as real estate agents, but this applies very much as for your W-2 employees as well. But asking yourself, as far as the way you treat money, do you treat money that way as though it is currencies of your time? When you're making that decision on what you're investing in or what you're purchasing, do you look at that as 20 hours of your life that you just spent to get that thing? And when you start doing that very quickly, even like a $5 Starbucks coffee in units of time can actually become a really disturbing thing on how much time I'm trading away for coffee in aggregate. But I won't get all weird on you. Can we get next slide? Please get weird. Yeah. All right. So we talked about it. Would we buy Trish or would we buy Ray? Right? Like that. Would we buy? And there's a few approaches that I quoted Warren Buffett at the beginning. There's 2 types generally of analysis when it comes to approaching on how you're going to buy a stock. That's I'm going to talk strictly about fundamental. Fundamental looks at these 3 reports. Does anybody without reading the screen actually know all 3 major financial reports that a company would do? You got them right? What are they?
What, you're talking about
all 3 of them without reading them.
Well,
the
balance sheet,
Yeah.
profit and loss statement,
Yeah.
and
Cash flow.
I was gonna say return on equity.
Nope, cash flow. That's good though. Most people, the most important one for us as individuals is going to be your profit and loss, which is what most people do without knowing they're doing it. That's when you look at your own money, you ask yourself, what am I making on income? What am I spending on expenses? And what's my net at the bottom of that? Fundamentally, that's what we're doing when we're doing a budget as well. We're doing almost a profit and loss statement. But if you really wanted to know how much Trish was worth, if you were going to buy futures of Trish, then you would ask yourself these questions because you can hide a lot of data in them, especially the balance sheet, because I'm going to go over assets and liabilities. They appear in that. Profit and loss is much more of within a set time period, what comes in, what goes out, and cash flow is actually following the money. So 2 of those 3 statements, you can make a business look extremely profitable and good, right? Like we look at like something like an Enron, right? Or WorldCom for those people old enough to remember all of that. You can make these companies look really strong if you're not actually tearing apart the financials, but then you have really savvy people that are looking at the financials and saying that if you can toy with these documents the right way, you can really bluff what something's actually worth. But if you have all 3, you should be able to get a pretty good idea of what you're worth yourself. And it's a fun experiment to sit down and actually do all 3 reports for yourself. Yes. But revealing, I guess, would probably be a better way of doing it, revealing. But for most of the day, we're just going to actually look at the profit and loss statement. So what is an asset? Anybody without reading?
Something of value.
Okay, that's good. That's actually almost Oxford correct. So there's actually a difference. I included both here, and I don't these are general principles, and I think later I'm going to discuss why it's actually interesting. So Oxford says that it's property owned by a person or company regarding as having value or and available to meet debts, commitments, or legacies. That's Oxford. Obviously, it's a non-financial institution. I use general internet financial reference for the actual definition. An asset as a resource with economic value that an individual, corporation, or country owns and controls with the expectation that it will provide a future benefit. Difference between those two definitions is actually incredibly important, right? Because accounting an asset's one thing when we're looking at a balance sheet. But then when we're talking about it, and we're going to get to this a little bit later, the definition of asset changes depending on who you're talking to and within the scope of what you're talking about. So most people think of assets in two categories. Anybody give me an example of an appreciating asset?
Land.
Land is a good one. Depends on where the land is, though.
Yeah.
The assumption that something's appreciating is actually kind of tricky. So we don't know what exactly is always appreciating, right? Because a house is usually what people point to when they say real estate is going to be an appreciating asset, but that's not always true, right? House can burn down and then the value is almost gone, you know what I mean? Unless you can rebuild it, right? The land, which is the good point, if you look at the last 120 years, you would say, yeah, land is an appreciating asset, right? Almost on any given stretch, it's going to gain value over a period of time. Anybody got an example of a good depreciating asset that we spend exorbitant amount of money on?
Car.
Cars, exactly. Except in the rare case that there are car collectors out there that are able to buy cars and use cars for short periods of time and flip them for greater value. But in most cases, your car finance, we won't even get into leased, but your car is going to be a depreciating asset if you want to call it an asset, but somebody's going to disagree with us later. And the other thing I want to talk about with assets, right? And I'm only strictly trying to get loose terms here for the people here to understand the basic language of it. Liquid assets really important, right? Because people in their companies, right, you can have all of your money tied up in a house, which is called house poor, right? But you have no liquid cash at all. So all of your money is tied up in something that's not easy to liquidate. And then you get stuck if you needed money, or you'd have to do something like pull the money out of the house or sell the house in order to create liquid cash. So liquid cash isn't necessarily material cash. It's just cash that can be accessed in an immediate fashion. And sometimes debatably that's within a week. Your high yield savings accounts, I would argue, is liquid cash, but sometimes you need 3 days to actually access it. But that's short-term usable cash. And you hear that a lot floating around in real estate. What's a liability? Right? It's the opposite of an asset. It's the other component of the balance sheet. Classically, it's defined as liability is something a person or company owns, usually there's some money. That's how it's translated. Liabilities are settled over time through a transfer of economic benefit, including cash, goods, or services. Example of a liability could be a debt, right? A debt of any kind, a small loan, anything that's depreciating at a faster rate than any asset, right? It's drawing money from a business. So kind of what Ray was talking about earlier in his 4 examples, that's where stockholder equity comes in with what you were talking about, is calculating stockholder equity, which would be at its most basic level assets minus liabilities. And that's mostly useful for companies with stocks and dividends. A dividend would be another example of a liability if you're paying out a dividend of some sort. What is debt? I'm not actually going to sit here, right? and talk about that. Everybody knows what debt is. Everybody got that? Yeah, it's money owed somewhere, right? Usually the idea with debt is, right, there's some form of interest on that, right? Like it was given to you with interest attached to it, which is going to bring us to our next slide real quick. Because this is important. And then I'm going to kind of more philosophically talk talk from here. These are kind of the conceptual terms I'm going to be working with today. All right, so simple interest and compound interest. Mortgage is an example of what?
Oh, simple interest.
Simple interest, yeah. And anybody got an example of compound interest? I know a handful of people in here know what compound interest is.
Mutual funds, everything like that.
That's good. That's in your favor, right? That's a version of compound interest where you are the one borrowing and you're benefiting from that, paid out in dividends or the equivalent. Anybody got an example of where you're losing money in compound interest? Loan sharks could be one. How do we go with legal loan sharks?
Adjustable rate mortgage.
That could be.
Amount.
Credit cards is probably a good one,
Okay, well,
right? Anybody here have credit cards? Okay, anybody have credit card debt? Okay, but still some. So credit card debt is a compound interest that actually accumulates on a daily basis. Student loans is another one. Well, because you're on the spot. Compound interest is such a miraculous thing, right? Like that's how we're able to set a small amount of money aside, and over any given period of time, that money, you can watch the money double, triple, quadruple, and that's how people get everyday millionaires, become everyday millionaires. It's just you're the credit card company in that case. You're depositing it with a financial institution that's now going to leverage your money elsewhere. So that's important, right? Because usually when you take a debt and it's some version of interest, the interest is discussed at the time of the loan, whether that's you depositing the money into a high yield savings account where you can actually make a little bit of money, or that's a CD or any other vehicle. Interest rate is discussed. Equally as important as interest rate itself is probably like things like what the company's doing with the interest rates, right? And we're going to talk about good versus bad debt in that debate. We go next slide. Who's that guy? Okay. Anybody else know who Dave Ramsey is aside from her? Super fun. He has no fun. He's the guy that tells you not to buy Starbucks, which Ray is afraid of. So Dave Ramsey is the owner of Ramsey Solutions, author of several books, as well as the 7 Baby Steps that a lot of people hear about. Dave Ramsey Solutions offers Financial Peace University, which would probably be a very good resource for most people who are not in attendance here, to fundamentally understand their relationship with money, right? Because through Dave's 7 Baby Steps, and I've been through Financial Peace University. I'm actually the local Ramsey Solutions endorsed local real estate agent. So I'm a big Ramsey fan. A lot of people carry debt, and a lot of people have a hard time getting out of debt. And his Financial Peace University is a really good way to sit down and fundamentally understand the basics of money that might be taught here in the future. Not sure if that's going to happen. I'm going to talk about him in a minute. Next slide. Who's that guy? Anybody got him?
oh, I forgot his name.
Forgot his name. Probably someone on YouTube,
Grant
right?
Cardone.
Yeah, there we go. Who was that?
Uncle G. It's Erica.
Yeah, Uncle G. See, she's got it. So he is we'll call him an entrepreneur, right? Primarily, most of his money early on was made through selling sales training courses. So he taught a lot of like automobile salesman courses, and a lot of that was what his early instruction was. And then he got into real estate investing, and he started author of 10X, the 10X rule, which you've probably seen around a lot, as well as the millionaire real estate investor pamphlet. He's going to be polar opposite to Dave Ramsey here in a second. These are like 2 bitter rivals who are very clear that they don't like each other publicly. I've actually heard Grant call Dave out on stage at his big annual convention, and Dave clearly refers to Grant kind of comically. The reason I bring up both is you spend enough time investigating money, and you're going to find people with different philosophies on how to handle money. I think it's important for people, especially if you're clicking through YouTube and you could run along Dave Ramsey or Grant Cardone, is these guys have a very solid understanding of the basics of money before they get into their graduate level philosophy on how to utilize money. And I think a lot of people sign online and they read it and they want to go do what Grant does, but don't understand at a very basic level the suggestions because they don't dive far enough. And Uncle G says, you know what I mean? Like he's all about leveraging debt, and he's very big on leveraging money. But if you catch him in a lot of his hour-long podcasts that no one actually listens to, like he's very clear that unless you have like $250,000 cash, like you have a cash problem and you shouldn't be worrying about any of the rest of it. Like you should be going out and getting cash is what you should be doing. So let's flip to the next slide. All right, so Dave Ramsey versus Grant Cardone, good debt versus bad debt. Dave Ramsey generally feels that debt is bad, right? Cash is king. And Grant Cardone, generally, if you catch him on a soundbite on Instagram or TikTok or YouTube, is going to tell you to borrow everything to spend money. So what makes a debt good debt or a bad debt? And what does it mean to leverage debt, right? These are things that I heard quite literally saying in another class about somebody who wanted to leverage debt. So Dave's personal story, and I implore all of you to go in and look into it if you're not to, but the idea is he borrowed a bunch of money when he was early on in order to leverage this massive real estate portfolio. And at the time they all had calls on them. So the market crashed and they all got called and he didn't have enough money to bail out. So he found himself from going from being a multimillionaire to literally bankruptcy overnight, like losing his own home. Obviously with the fixed rate mortgage, a lot of that's different now. Dave is very classical in the way that he approaches that. And Grant is very balance sheet oriented in the way that the idea is if you borrow money, right, and you can make more money than you're borrowing, then you should go do that. Why would you spend any of your own money if you can spend somebody else's money to make more money? So leveraging debt. Does anybody know what leveraging debt actually means? Like in actual fundamental practice, what the principle is? All right, because you hear people all the time, and I'm going to talk about the. Actually, let's flip to the next guy, and we'll come back. Who's that guy? Anybody got him? Robert Kiyosaki. Rich Dad, Poor Dad, and a few other cash flow quadrants, and a few other. We'll jump next. Go next, and we'll go back to. Okay, so he has a different definition of assets and liabilities, which is going to become important when we're talking about leveraging debt, right? So for him, an asset at its most principal level is something that puts money in your pocket. So Robert's definition, if you were doing your own business up to this point, classical accounting would tell you that your house is an asset. Robert says it's not. Your house requires money, doesn't actually put money in your pocket every month. It's not actually getting you anything. Investment property could, if it's bringing in more money than you're outputting, then that becomes an asset. But your own personal home isn't an asset. And he covers that really well in Rich Dad, Poor Dad. I'm not here to reference all these things, but if you haven't read those books, I strongly recommend it. At inverse, he says a liability is anything that's taking money out of your pocket, right? So that's a car, that's your own home, that's your utility bills, that's everything. And a lot of people, he's looking at this fundamentally and practically in a way that affects us on a day-to-day basis. We're not accountants working for a corporation that's trying to differentiate how much of your car is actually an asset against your own life versus the liability of what's actually owed on the car for shareholder purposes. So a lot of people tap in, obviously, and everyone's gonna have different opinions on all three people, and there's more that I wanted to include, but those three at the most basic level. So leveraging debt. What's my next slide? I don't know if I actually touched leveraging debt from there. Okay, yeah, let's go back. So leveraging debt, this is a principle you hear a lot. Grant Cardone talks about a lot. Robert Kiyosaki talks about it a lot. The idea is that if you're buying an investment property, and back in the day, a long time ago in a galaxy far, far away, there were 2.875% interest rates, right? Which was only 2 years ago, but it feels like a galaxy difference. You know what I mean? Exactly. So ROI, return on investment, right? And I should probably cover that in a different set of slides, or maybe I'll redo that next time I do this. But the idea is that if I can borrow money at 3% and I can make 7% on that money, then I've made 4% on every dollar. And that's where the Grant Cardones and Robert Kiyosaki's were right. That if you can borrow money cheaper than you're able to make money, that makes sense not to spend your own money, because what you're doing is you're just making money on cash. And a lot of people, I think, get into that when they're in real estate or they're new into flipping properties or they're trying to build a financial portfolio, which I'll get to much later. They hear this idea that I can go to a hard money lender and I can borrow X amount of money at X rate and, fix up this house and sell it at this. But everyone in the room is pretty seasoned at this point. Like, that, oh, shit happens, right? Like, and your margins weren't as good, or in a matter of 3 months, the Federal Reserve decides that they're making a run on interest rates and the entire housing market freezes, but that doesn't usually happen. But like these moments happen, right? So projecting the next 6 to 12 months on a new construction project becomes very hard with tight margins because you don't know what's going to happen. So if you're over leveraged is what happened to Dave. Dave had unfavorable loan terms, but even in the fixed rate loan world, like you can find yourself upside down on something very quickly. So Warren Buffett's big. He was big on don't borrow money for anything you can't buy cash, which has generally been my rule in life is I will borrow money, but it's only if I can pay that debt off at any time and I'm just deploying the money elsewhere. So it's my feeling, and I don't want to get into the baby steps, but right, like until you yourself are in a position where you as a person or a company are profitable, right? You shouldn't necessarily be worrying about how to leverage debt in order to, if your own home isn't something you have your head wrapped around, your income's not paying for your own home. It seems foolish to me that you're borrowing hundreds of thousands of dollars from a financial institution when you owe hundreds of thousands of dollars on your home in order to try to flip a property on the speculation that you're going to make $10,000 later in the face of all the risk you're taking on, which is what you discover in the three financial statements. So it was asked of me, what's like the most basic, kind of like piece of advice you can give, and that's writing a budget. So how many people actually have a written budget that doesn't exist inside their head? Do you update that regularly, or is that kind of just like you did that once and it's kind of cool?
It's not like 3 times a day like you, but I try.
Okay. So how often do you look at your money? So Greg Cardone says he wakes up every day and he logs into his bank accounts and looks at his money. If you don't look at your money, if you don't give it attention. I do, yeah. Yeah.
So I don't do it every day.
Okay.
Not often enough. And
Okay.
That's why this class in particular interests me.
Yeah, no, of course. No, and that's the question.
Most people do.
Most don't. No.
Most people like don't know how much is in their bank account and then they check it like before they go pay their bill.
Yeah.
There's a lot of jokes about that. We hear that with every while.
All the time.
I mean, realistically speaking, I look at mine every couple days,
Okay,
but I also get paid bi-weekly.
yeah.
So life's very different for her, and we're going to talk about that in a minute when it comes to actually the budgeting versus us, the pirates who are out there on the frontier chasing the booty, So budgeting, right, for a W-2 employee who gets a bi-weekly or weekly paycheck is much more simple in the fact that it's fixed, right? Like you can actually predict what your income is going to be. For us, we have to take high risk, high reward, right? Like we have the opportunity to make, in most cases, substantially more money than W-2 employees going to make. But with that, our financial health needs to be a lot stronger, right? So what does that look like? 6 to 12 months worth of cash reserves, right? Set aside for yourself and your business, which is a lot of money. Like, and we're going to actually break into the budget, but how many people have any idea how much money they spent last year on their own personal life?
You said for yourself and for your
Yeah.
business. I caught that.
What?
You just said for yourself and for your business.
Correct.
Okay. Most people won't do that.
No, they don't. But most people, and that's where the argument is, and mine would be over conservative. A lot of people say 3 to 6 months. But I think especially in real estate, if you are heavy in advertising, or your monthly bills look big, like my monthly bills can be $10,000 a month bills every month. Like you have to have a substantial amount of money set aside in case, like I am right now, going through a couple months of not, having regular commission check coming. Oh, it happens. It's my own making. So a budget simply is like that profit and loss statement where you're going to have your income and then your minus expenses. And we're going to do actually real life example by a guy named Alex who totally didn't screenshot his own P&L and put it in here. but it's going to be basically just like a P&L of going through how to do income minus expenses for a real estate agent, which can be very similar to W-2 employee. But what does that look like and why do we do it? And then there's something Dave Ramsey does, which is called zero-based budgeting, which I'm actually going to circle back to later because it's helpful for people to have revolving debt or debt that they need to take care of. Writing it as a zero-based budget is extremely important, especially when you're new in the industry, which no one in here is new in the industry, but it's very important if you want to get your business off the ground. Yeah.
Oh, nine?
Yeah,
Um,
that's fine.
I guess. All right, next. All right, how to create a budget. Fundamentally, it is very simple. It's income minus expenses equals your net. Knowing your historical data is important, right? So if you've lived in the same home for the year, you can go back and you can, whether use QuickBooks or any other form of accounting software, Every Dollar by Dave Ramsey, you can go back and track every dollar you spend on your home, and you actually have a historical idea of what your house costs you every year. Because if I'm looking at my electric bill in December, it looks like maybe like $100, right? Like in December. But if I'm looking at it July to August, which is the bill I just got slapped with, it's $580 because I'm running AC. So it's like, which do I budget for? I budget for the average of the 12-month look back on things that I stay kind of in there for us. And that's what the importance of historical data is. And when you're doing an expense budget, in my opinion, the order of things you should look at is your four walls. Dave Ramsey actually refers to them. It's your food, shelter, utilities, and transportation. So those are first four items you're going to put up there. They're the essentials to life. Because the rest of them we can mess with, right? Like you don't need the Starbucks cup of coffee. You don't need a lot of what we actually like. You don't need those clothes. You don't need that food. You don't need that takeout. And you might not need that house. You might be overspent on your house. And that's kind of a case by case basis for you to sit down with somebody who's not just a dumb real estate agent. But once you get past that, there are other essentials such as healthcare, health insurance. You know, I mean, that comes out monthly. If that's school fees for kids or like whatever that looks like for you. Then it's the debts. Once you know that you can sustain a life, for me, that becomes next is the debts. Now I'm looking at the minimum payment on debts. I know people that have 8 lines of actual inquiry, and that includes, credit card debt, that includes student loan debt. Sometimes it's 7 student loan debts. So when I'm doing this with someone who has 7 student loan debts, we're taking the minimum of all 7 minimum payments and the minimum on whatever the credit card is, or revolving debt or whatever it is. Now, obviously, this doesn't include mortgage. That doesn't include your car note. That doesn't include everything, which is already up there. So we're looking at the debts, right? And we're looking at the minimum payments. And then we're going to talk about the extras. I'm going to return back to the debts for the zero-based budget. Man, I was told to keep this under 30 minutes. That's not happening. So when I look at the extras are the coffee, which you don't actually need. Now you can do extras like coffee and not do it from Starbucks. You can have a coffee maker at your home and you can buy it from Acme, right? You don't need the coffee though. The coffee, even from Acme, is not required. Some people on here will argue with me about that. But the coffee is not, required, or the protein for the gym is not required. And you go through all the non-requirements, which haven't been directly covered yet. And the rest of it's it's extras, right? That we get to enjoy because we're in a first world country, right? These are things that we take for granted that we don't actually need, name brand shoes, nice, sweatshirts, all this stuff. But people live comfortably enough on less than $20,000 a year all over the United States. I say comfortably enough, meaning they're far more comfortable than people in Afghanistan, people in a lot of Asia, they're living better-ish. So when I got in touch really with what the extras look like, it was disturbing how much money was left on the table, that I was using for extras. So as long as I know that they're extra stuff, it's fine. It's just you have to account for them that way, especially if you're chasing 30% revolving debt on credit cards you shouldn't have had in the first place. That coffee doesn't become as necessary as it was before. Adhering to a budget, it's like a diet. you can write the best diet in the world unless you stick to it. It doesn't matter. Somebody can hand you the Millionaire Real Estate book, right? And you can read it, but unless you do it, it doesn't matter, which is why I shouldn't be teaching how to build a team, which was accidentally put out in an email because I didn't listen to the book, right? And my own experience was zero-based budgeting. So zero-based budgeting versus regular budgeting. Regular budgeting, you're gonna have a profit at the end of the month, assuming you're healthy, right? You're gonna have some form of like, say, after my income and all of my expenses, I make an extra $900 a month, we'll just say. Zero-based budgeting literally budgets that down to zero. So once I have that extra amount, which is that profit, what we regard as net profit, that money is then reapplied to all of the debts, or whatever else there is. So whether that's, you're planning on getting a new car, which is a sinking fund, you're putting the money towards a sinking fund, or you're applying the money everywhere. So no dollar goes unaccounted for when you're doing zero-based budgeting. So in the case, if you're carrying debt, the two popular ideas behind paying down debt are your debt avalanche and your debt snowball, right? Debt snowball is the Dave Ramsey thing, but debt avalanche is how most people approach it, which is you pay down your highest interest rate debt first, and then you work on that until that disappears, and then you work your way down to a small. So debt snowball, which is what Dave Ramsey espouses. Dave would murder me for saying this, isn't actually functionally, financially the best way to go about it. However, most people are not capable of displaying themselves to actually follow the avalanche through. That the snowball is a better approach, which means you pay off your small debt. Say you owe $100 to a specific credit card, right? It's one of 5 credit cards. You pay off that credit card first, and then the next small debt, and the next small debt. And then as you become to believe, because you've now paid off 4 of your 9 revolving debts, you're like, now I can actually do this, right? And it teaches us that we are capable of doing this. That's snowball, the smallest, the biggest. Highest credit to lowest actually financially will have you pay off sooner. Problem is most people don't actually have the discipline to do zero-based budgeting, where they're taking the extra $900 a month and applying it to a debt. They're applying that to Target, they're applying that to Starbucks, they're applying that to Chick-fil-A, they're applying that to, yeah, like all the things. They're applying it to everything but that. So that's the usefulness of zero-based budgeting, is you're not actually stuck in a position where your vices have the ability to control what happens with the $900. Can we go next slide? Oh, as a new agent. For the new agents on the call, my second year in the industry, I think I made $31,000 that year. I did exactly this approach. I had no debt because I've just been wired this way. But once I got done, all of the things were paid for, all of the expenses were accounted for, and I had left over my $10,000. That $10,000 went back into the business, all 10,000. Zero-based budgeting, all 10,000 went in. Then next year, we'll say it was 40, I have the numbers, but they're not here, but 48,000, right? And I only needed 31 to live. That 17 went back into the business. So the way I approach this, which is one of the things that was asked, is how did I do early on? Like, how did I build my business? Is I zero-based budgeted myself into getting to a place where I was spending $10,000 a month on my business. Yes. But I had to work myself there. You know what I mean? Like, had to get myself there. 10,000 is not spent on the business. We're actually going to do my finances here in a second. So that's how early on, like if you know what your actual fixed expenses are, you know how much money you need to make, either you know what you need to sell, or you know that you need to go get another job, which is what that's going to reveal to you pretty quickly, is you might have to go get another job. You might have to be a dual career agent, because in actuality, like, your expenses are way higher than your income is. You're already chasing credit cards and you're not able to get yourself out of the hole. And there is a horizon line where you can't actually get yourself, and this is what's happening with student loans, which is what all the litigation's about, is there are student loans that people legitimately will never pay off unless a large sum of money comes down and pays it off. And that's important to figure out, because a lot of people, I think, try to do the right thing by their, businesses or by themselves or all of that. And they're looking at a horizon line of money they can't actually ever pay back. You know what I mean? If you got at a going rate of $80,000 a month and you're only making $45,000 a month, like there's a big disparity there where you're not making money. And that's important to figure out right before, for me, I wouldn't invest in myself as a new real estate agent trying to buy 10% of my own company if I knew I was buying into a company that was over leveraged with debt. And there's some of this in the news right now, right? Like real estate companies are over leveraged with debt that have no expectation of actually paying it back. I would never buy into that company, and you wouldn't either if you actually like sat down and thought about it. But for me, that's the importance to think about yourself as a business. So let's take a look at some person we shall name Alex. So it's an example of as close to zero-based budgeting as I could kind of put together for the sake of this presentation. So in order to actually float life, go 2 slides forward. So my life, according to this, my personal life cost me $57,604 a year, right? So this is the zero-based budget approach. I did this in reverse. And we're going to go through it. So you don't have to sit and read it. I had to figure out how much money I actually need to gross sell in order to bring home enough money to pay for my life as it exists. So can we go back 2 slides? All right. So that meant gross income of 165,000. However you get there, however you skin the cat, it's up to you. You know what I mean? Whether you got to sell a bunch of beachfronts or you got to sell 50 small units, you know what I mean? Like that's the number you need to make. In the income section, I personally choose to pull out business expenses first because this is my personal, as though I'm looking at the P&L as me as a business. I look at business expenses out of would COGS, which is cost of goods sold for anybody that's actually doing the accounting. And then that's my adjusted income, meaning that I pull my expenses out. I contribute to my retirement before I spend another dollar. That's just me personally. So that money has to come out. So it's 17,000 based on the 100. And that's the maximum I can contribute to a SEP IRA taxably without any liability. Then my taxable income becomes 83,000. And these are just examples. Once again, I'm just a dumb real estate agent. I'm not an accountant. Don't take your financial advice from me. And then federal and New Jersey taxes together 25, and that leaves me with my take home of $58,000. Obviously, that profit looks bigger if I sell more than that, but this is kind of your zero-based budget on how to exist in life. Any questions on this? This is where I'm going to kind of just like step by step kind of go through how to build a budget, sort of.
So that 58 you're putting into your business next year, or
No.
that's the 58 that you're living on?
No, this is my revenue.
Oh,
This is my revenue.
Starbucks.
That's Starbucks money. No, it's not. All right, so that's strictly income. That's what I'm taking home, which is kind of crazy to think about because I made 165,000. I'm really taking home 58,000 at the end of it. Most people will be really disturbed to find out actually how that money actually flows at the end of the day. And we can talk about the tax system a different time because that'd be worth probably explaining. Could we go next slide? This is gonna be an example of expenses. And if anybody wants this, I literally have it broken up to a personal auto calculating version of this. So if anybody personally wants this, I can like literally send it to you, not in screenshots and in actual Google Sheets. But those are examples of houses, right? We think of mortgage automatically, but that also involves landscaping, sprinklers that happen to blow up 3 times in the same year. And miscellaneous things that are always going to come up, right? Those are things that kind of pop up. Automobile costs, those 4 walls. Remember we talked about the 4 walls. So that's the order that this is appearing in. Car insurance, car maintenance. That's another big thing people skip, or how much money you're actually spending on fuel is another important thing. Yeah. So if you have your historical data, it's kind of easier to follow along to know what you're actually looking like. Because all of this comes in seasons and waves. So to know year over year what your health looks like is important. Because some months you're going to close 13 transactions, and then for a couple months you're going to, you know what I mean, do nothing, and it's just the way it goes. Next slide. And call from Poland right now. Other essentials: phone, grocery, healthcare, living expenses, living supplies, eating out. Yeah. So all of that money kind of is put together. If I was new to this, I would remove restaurants and put that in other expenses. I would move that down. And then other expenses: Disney Plus, vitamins, Xbox Live, very important. almost an essential that should be moved up higher, actually. And then the gym, right? Yeah, you go to CrossFit gym. That's actually cheap for CrossFit. So this is broken down just because I didn't explain it before. It's daily, weekly, yearly, or weekly, monthly, yearly, daily. Just so you see how the money actually fleshes out. Because a lot of people think of their income in a salary as $40,000 a year, but they don't think of it as X number of dollars a day, $210 a day. So when you go and you buy 2 coffees from Starbucks, it's quite literally like that could be up to almost, we'll say 7% of your daily income you're just spending on Starbucks. I'm not to beat up on Starbucks. I like Starbucks. Everybody can't see I have Starbucks in my hand. But just understand what you're doing with that money. And then we go to the bottom, kind of see how it nets out. One more. And then those are the nets. And that's almost as though I was doing zero-based budgeting for myself. That's close. I wasn't going to sit there and really tinker with it. I would have miscellaneouses. I would have groceries. In my house, my fiance takes care of the groceries. I take care of like there's trade-offs there, that which is why they appear at zero. But each person individually, whether it's your girlfriend, your boyfriend, your husband, your wife, whatever, yours is going to look different. But it's important at the end of the year to know what your actual revenue looks like. Whether or not I'm going to buy into my own business, because there are a lot of real estate teams out there that sell several hundred units a year, like large real estate teams that like don't let anybody look underneath the hood of their business. Because like in truth, like they might be making, we'll say $250 million a year, but they're spending $200 million a year to make it. So a lot of times you can have these large real estate teams that make things look really flashy, but your solo agent could be far more profitable than your big, sexy real estate team with all the cool signs. But unless you look at really what the money looks like, no one's actually gonna know what that is. So that's an example of the personal. Can you go next slide? All right, retirement or get rich. Is there any questions on that before I kind of jump forward? I don't think there are. You let me know, right? No. Okay, cool. There are a bunch of vehicles as to how to get to retirement, right? And we talk about them all the time, whether SEP IRA, self-directed IRA, we were talking about earlier. Real estate portfolios, right? Like everyone wants to get rich doing real estate. Cryptocurrencies, right? Like savings. Some people just put savings cash into a savings account and they think they're going to retire. You're better off with a plan and consulting a financial advisor of some sort or an accountant. As Ray kind of talked about earlier, the power of compound interest is kind of eighth wonder of the world, as Einstein said. However, that's what it looks like over 50 years. And we sat here and broke down what your investment looks like if you start investing at the age of 20 versus the age of 30. You're talking about hundreds of thousands of dollars just lost in that 10 years based on compound interest alone, not investing another dollar. But that's the importance of a plan and a discipline of it, because it's really, unless you have it built into your budget, it's really hard to try to cough up that extra $17,000 a year to go into retirement, because you're going to think of a bunch of things that you'd rather do with that 17,000 real quick. Rather have a new bathroom. I'd rather have this. I need to get a new car. Like, unless you're used to doing the actual budgeting, and you know what that money looks like and the possibility for that money, you find yourself at a point where you have to figure out a get rich quick scheme because you ran out of time and you have no plan for retirement. And then people get desperate and make really bad decisions trying to make money quickly. And then you're chasing Dogecoin, right? It's like essentially what you're doing. But no, and that's each individual person based on their own risk level and risk tolerance, right? Like you have to figure that out on your own. But at the end of all of that, like for me, my goal personally is to get to a point where I don't have to sell real estate to make money anymore. And I can just sell real estate to who I want to sell real estate to. I think that's really the dream for all of us that are here, right? Like you're a real estate agent because you're kind of a dreamer and you want to like do it, right? Like you want to have that life. And what that actually looks like without a plan is a lot of stupidity. You know what I mean? Like you're just chasing dreams. And there are blueprints on how to get here, especially at Keller Williams. I think it's just questions next. Questions. Oh yeah, at the bottom, very important. All complaints regarding the speaker or the content should be addressed to the MCA or OP who thought it was a good idea to have me speak today.
Say TL.
Yeah, it should be actually
I thought it
TL.
was it should be Tom
I'd
Allen
like
in
to
bold.
blame Tom.
Yeah, it should be Tom. We need to revise that
Yeah.
later. Any questions, or is there anything else that you wish was covered that wasn't covered?
I wish more people were here. That was a great.
I'm
job.
not worried about that.
I want to know, is this an original Alex, the budget is like a diet, it doesn't work unless you do it.
That's me. I just said that, kind of just
Is that your plan?
on the hip fire. I don't know. I just said it. You can give me the credit. It's fine. I'm sure somebody else has said it before. If you look around enough, I'm sure somebody said that. All right. So is there anything else anybody would like me to attack next time? Somebody said they would like the tax system explained to them about how actually the progressive tax system works.
I think you'll have much lower attendance.
Yeah, exactly.
Cause
Not-
I like that, but I want the, you know.
Not when you get to the top though, right? Like the difference between a 12% income tax versus 24% income tax versus a 33% income tax, and how people actually get taxed on the percentages of their money as they continue to make more money.
Oh, you mean actually just like explain the tax.
Explain how that works.
12% on X%.
Yeah, because a lot of people Google that I have to put aside 15% of my money for taxes.
Right.
And then at the end of the year, they find themselves $45,000 short. And they're like, what happened? I had a really good year in real estate. And they didn't realize they really should have been setting aside 31% at their current tax income.
Oh, so this is a set amount, not based upon.
Yeah, their income levels. Yeah.
Quarterly.
Well, that doesn't help. We can debate that.
Actually, a really good tax calculator. It's good for agents.
Yeah.
That's,
Can
it'll
you
just,
share that?
yeah. we'll just-
And also fire is cool. Financial independent, retire early. Like if you really want to get like tuned into this, fire.
Yeah.
Um,
10 and a half or 7?
you can go to the website. It's a book too. Financial independence, retire early is the acronym. It's really cool to see if you're disciplined, how much money you can set aside into like an investment vehicle, and based on the return, how quickly you could actually retire. For a lot of people, you'd be disturbed.
People have been disciplined and all of a sudden.
Yeah.
2008, 2009, they lose 40%. And who knows what happens in 2022.
But they would have recovered that by 2021 and then some, like 15-fold.
I know, but it's not if they're 65 years old.
If you're forced to retire at that moment, then yeah. But that's the issue is like you've never like right now as the market begins to dip, your clients aren't losing money on their house. You're only losing money on your house the second you liquidate that. So same thing with people are retiring right now. I know a lot of people who are retiring right now are drawing from the retirement. They feel like they're losing a bunch of money, but what they're really losing is the percentage of what they're drawing every month. When it recovers again, you know what I mean? Like they're going to be drawing from a lesser amount, but that's a compound interest question. How much you actually have set aside for retirement. All right. If there are no questions, we're kind of cool.
Thank you so much.